The S&P continued the sell-off today, down 1.22%, closing at 5778. There was an afternoon rally attempt that got all the way back up to the 50 EMA, which is sitting at 5870. That ultimately failed in the last half hour, closing below the big 5800 strike. So the market continues seeing a series of lower lows and lower highs cascading down to about 6% of a sell-off since this high back on February 19th. So we're squarely in the 5 to 7% correction territory range. This is a typical range for moderate corrections. And this 50 EMA line is sitting just below the overall downtrend line that has formed. I'm looking for a move back up above both the 50 EMA and the downtrend line to confirm a reversal. That also corresponds approximately with where our zero gamma exposure level is, just above the 5950 level. So we need to get above that major zone to at least get back some bullish momentum. From a gamma exposure perspective, we've got zero DTE rolling off at the 5770 and 5775 strikes. The rest of the gamma exposure is concentrated at the 5800 strike and the 6000 strike. So this is about the same setup as we saw yesterday. Not a whole lot really changed today. I mean, this rally and failure, of course, is not what bulls want to see, but the gamma exposure setup and the volume in the options market are giving us the same basic structure as what we saw in yesterday's trading session. As we mentioned in yesterday's video, the close below the 5800 strike is somewhat concerning, and so we need to see a move back above that level to have any chance of bullish momentum coming back. As far as bears are concerned, they are still happy because we're still solidly in negative gamma exposure, and we basically have 8 straight trading sessions in negative GEX territory. So it's no surprise that we've seen the sell-off continuing as long as we remain in negative gamma exposure territory. Volatility expansion is the name of the game, which lends itself to more natural downside. So bulls, of course, want to see a move back up into positive GEX territory, see a bit of a gamma squeeze with all of those puts being closed out by market participants and option dealers unraveling their short hedges. Let's take a look at Bitcoin. Bitcoin actually doing pretty decent this afternoon, rallying from about 81,000 midday to currently sitting at 87,000. So pretty big rally in Bitcoin. This is our favorite indicator to gauge risk on sentiment. So this rally this afternoon in Bitcoin holding while the rest of the market kind of sold off in the last 30 minutes of trading is actually a positive sign. And we still see positive gamma exposure concentrated at the 100,000 strike on Bitcoin. This obviously is a previous resistance level. And so if we can get any kind of momentum coming back to the crypto markets, this is our initial target for a move higher. We're currently solidly above the zero gamma exposure level at 85,000. So things are looking halfway decent for Bitcoin. We need to see this momentum continue and to spread over into equity markets as well. Taking a look at the VIX, this is basically the inverse of what we saw on the S&P. The VIX supported by the 50 EMA, which is currently sitting at 2175, while the VIX is at 2351. We've got the largest gamma exposure concentrated at the 25 strike, and the VIX did hit that here earlier this morning. Zooming out, if we take a look at the options volume today, it appears market participants are getting a little bit more concerned. Check out this volume on the VIX at the 30 strike. 250,000 contracts traded today alone at the 30 strike, nearly 200,000 contracts trading at the 35 strike. So this is more and more market participants trying to protect themselves, trying to protect their portfolios for a potential volatility spike up into the mid 30s or even 40s. In my opinion, these individuals are a little bit late to the game. In terms of hedging in our own portfolio, we closed out half of our position. We have the March 21st 600 585 SPY put debit spread. So that put debit spread has been serving as a hedge against the rest of our bullish position, and that's really paid off over the last couple of days. So we've locked in half of those gains. We're obviously well below the 585 strike. So on the next large bounce, we'll likely reinitiate an additional hedge position at probably lower strikes than where our previous hedge has been, which, by the way, you can check out our community Discord and follow along with all the moves we're making in our portfolio, link down in the description below. Next, let's take a look at a few individual names. We'll start with Tesla. Tesla getting hit today, down 4.5%, closing at 271.92. And basically, Tesla cannot get out of its own way, coming from the mid 400 levels all the way down to now below 300 in just the last 5 to 6 weeks. So far, everything is pointing down for Tesla. All the indicators that we're following, including gamma exposure with the largest negative concentration at the 250 strike. So all rally attempts in Tesla appear to be getting sold, and this 250 strike looks like a potential target here in the near term. If you're not already short Tesla, you're way too late to the game. So we're actually looking for a potential long position at or around this 250 strike. We were actually looking up here around the 300 strike about a week ago. The bounce never really materialized, and so we did not get a signal entry at that level. So we're going to be looking for potentially further downside, and if we do get down to this 250 strike, we'll be waiting for our signals to trigger and potentially enter in a speculative position for a bounce at least back up to the 300 strike. Again, that's all speculative now, but we like to work through different potential scenarios and our response to those based on the data. So this is going to be something that we consider adding to our portfolio for a speculative bounce here in the coming days. Interestingly, not everything was doom and gloom today. Google up 2.35%, closing above the 170 level. Google has actually found some support here below 170 over the last couple of trading sessions. And so being the zero gamma exposure level at 170, we still have large gamma exposure concentrated at the 200 strike. So that would obviously be a big move, 15% between here and this 200 strike, but that is not out of the realm of possibilities for a move if market momentum comes back. And so we've got these potential targets in our sights in case market momentum comes back. Again, a number of factors would have to happen for that. We need to get back into positive gamma exposure territory across the indices, the S&P and the Qs, as well as on some of these individual names. Google looks to be taking the first step here, so we've got our eye on that in the case market momentum comes back. And just to reiterate, these are relatively longer term plays in terms of option strategies. And so we're currently in an option strategy on Google going out to the April 17th expiration. And this 200 strike is something that we definitely have our eye on. Next up is Meta. Meta trading at 640 as of the close today, getting hit along with a number of other names going back the last 2 weeks, trading from the 740 level now down to 640. So over 100 points lower on Meta. We still have large gamma exposure concentrated at the 700 strike, and we still have interest in the options market. Volume coming in today, over 30,000 contracts traded at that 700 strike. So it's not out of the question for a move higher. This would be approximately a 10% move higher from where we are now to reach the 700 strike by March 21st. So that's something that if you got a speculative view and a positive outlook on Meta longer term, that you could consider with the speculative part of your portfolio. And these are the kind of setups that we love. We love to see big sell-offs down to our lower dealer cluster level with large gamma exposure concentrations overhead, as well as volume coming in overhead. These are the kind of setups that we love to add to our portfolio, knowing that the probabilities for a bounce back up to these higher strikes is on the lower side. So this may be a 30 to 40% probability. However, the payoff could be 5 to 6x. If you're getting 5 to 6 times on your initial risk, that can still be a very profitable strategy. And so this is one of the aspects that we like to include in our portfolio. Even though this particular sub strategy is slightly lower probability, it can still result in significant profitable outcomes. And you can get access to our gamma exposure dashboard and our option flow analytics tools by heading over to geeksoffinance.com. We also just rolled out our algorithmic trading strategies today, so that's included in all memberships. So you'll also get that new feature as well. Members also get access to all of our premium channels in Discord. You can follow along to see what we're doing in our own portfolio, as well as get great ideas from the traders in our community. We've got a fantastic community, so you definitely don't want to miss that. Link in the description below. Thanks so much everybody for watching, and we'll see you guys in the next video.